In just 90 minutes, a number bigger than entire national economies was erased from the precious metals trade. Gold barely moved. Silver fell like a trap door. That mismatch is the clue, because this was not panic in the normal sense. It was a structural event, triggered by rules, not rumors. And the most dangerous part is this: the same forces that caused the drop can repeat at the worst possible moment. In markets, you rely on far more than metals. By the end of this briefing, they will know exactly what to watch, what level matters, and why the next decision by one institution could decide whether this was a reset or a warning shot. Welcome to GC Alert. Now, before we begin, if you're watching and you're over 50, you already know one truth: when something feels sudden, it was planned by conditions long before. So do the wise thing. Subscribe now and keep this channel close, like a trusted newspaper you don't miss. And tell them, where are you watching from today, city and country, in the comments, because the next detail changes the entire story. The morning began with a sense of certainty. Gold was trading near $500. Silver had reached $117.75, a level that looked like a victory lap after a powerful run. In the precious metals world, those numbers signaled momentum, confidence, and a market that believed it had control. Then the control vanished. Within roughly 90 minutes, the market reversed in a way that forced every serious operator to stop and reassess. Gold slid to around $5,000, a move near 2%. Silver fell to roughly $103, a drop near 12%. The headlines focused on a stunning figure, about $1.7 trillion erased in a short window. Whether the exact number was measured through market value or paper exposure, the real message was clear. Liquidity was thinner than it looked, and leverage was more fragile than most participants admitted. This is where disciplined analysis begins. A serious briefing does not treat price shocks as random disasters. It asks what kind of system could allow such a move and what the move reveals about the system's weak points. Decision makers should notice one fact immediately. Gold and silver are linked in the public imagination, but they are not the same instrument in market behavior. Gold often trades like a macro hedge, closer to a monetary barometer. Silver trades like a hybrid, part monetary metal and part industrial input, but also a favorite vehicle for leveraged speculation. When stress appears, those differences show up fast. The key signal in this event was the mismatch. Gold fell modestly, silver fell violently. That gap suggests this was not only a change in sentiment, it was an unwind of positioning, where the most crowded and leveraged trade was forced to liquidate first. The business community and young entrepreneurs should not dismiss this as a niche story about metals. The same mechanics exist across markets that affect financing, inventory, and corporate planning. When leverage is high, margin rules tighten, or liquidity steps back. Price can fall faster than fundamentals can explain. That is not a theory. It is how modern markets transmit pressure. This episode also exposes a dangerous misunderstanding many people carry. They assume price is only a reflection of value. In stable conditions, that can be mostly true. In stressed conditions, price becomes a reflection of balance sheets, risk limits, and forced behavior. The most important seller in a crash is often not a rational seller. It is a forced seller. There are two layers to what happened. The first layer is technical. Markets do not move freely across all price levels. They cluster around levels that many institutions watch, because those levels represent past turning points and risk decisions. When price hits a major long-term level, it can trigger mechanical responses from traders, funds, and algorithms. These responses are not emotional. They are rule-based. Stops are hit. Positions are reduced. Risk is cut. Liquidity retreats. At the exact moment, demand for liquidity surges. The second layer is structural. In futures markets, participants often control large exposure with a relatively small amount of cash. That structure works when prices move slowly. It breaks when prices move fast, and the cost of holding exposure rises. When exchanges raise margin requirements, they increase the cash that must sit behind each position. In a calm market, traders can adjust. In a fast market, they cannot. Many are forced to sell, not because they change their view, but because they cannot meet the new cash demand in time. This is why a short, sharp drop can appear to erase enormous value. The price drop triggers margin stress. Margin stress triggers forced sales. Forced sales push prices lower. That lower price triggers more stress. The cycle becomes a cascade. Once the cascade starts, it does not ask whether the long-term story is bullish or bearish. It only demands liquidity. The event also highlights another split that serious observers must track: the paper market versus the physical market. Paper markets can be driven by leverage and liquidations. Physical markets are driven by supply, demand, and delivery realities. In many historical stress events, paper prices fall while physical premiums remain firm or even rise. That divergence is not a small detail. It is a sign that the market is not moving as one unified system. With the strategic warning that matters most. In a world of high debt, tight supply chains, and heavy financial engineering, the question is not whether volatility will happen. The question is where the forced selling will appear first, and whether the next shock will hit an asset that businesses use as collateral, a currency pair used to pay suppliers, or an interest rate market that sets the cost of borrowing. This episode in Metals was not just a story about gold and silver. It was a demonstration of how quickly the system can reprice when leverage meets rules and when confidence meets liquidity limits. In Tereus, the analysis will explain the technical trigger in clear terms. It will show why a multi-decade level can behave like a ceiling, why silver reacted more violently than gold, and why this kind of move can be predictable, even when it still feels shocking. Focuses on the first trigger that made the drop look sudden but behave like a planned reaction. This trigger was technical, not emotional. It came from a price level that large traders have watched for decades. In modern markets, charts are not only pictures, they are maps of crowd behavior. Institutions use them because a chart shows where buyers historically defended price and where sellers historically blocked price. Those zones become decision points. When price returns to them, large pools of capital often respond in similar ways. That is why technical levels matter, even to people who dislike technical analysis. The market does not care about opinions, it cares about positioning and rules. Silver had been climbing into a region that sat near a long horizon trend line, a level that had influenced major turning points in the past. Years earlier, that same level acted as support during a crisis period. Support is a level where buying tends to appear when price falls. It is like a floor. A floor often holds because people see value there and because trading systems are built to buy near it. But markets evolve. A floor can later become a ceiling. When a former support level is broken and price later climbs back to it from below, many traders treat it as resistance. Resistance is a level where selling tends to appear when price rises. It is like a ceiling. That ceiling forms because traders who once bought there may want to exit at break-even, and because systematic strategies often sell into known resistance. This is the critical concept. The direction of approach changes the meaning of the level. In the past, silver fell into the level from above and bounced because the level worked like a floor. In the present, silver rose into the same level from below and got rejected because the level worked like a ceiling. That is not a moral story about right or wrong. It is a structural description of how markets remember. When silver pushed into that ceiling, multiple groups were already prepared to react. First were the short-term traders and systematic funds that use trend and momentum signals. Many of those strategies reduce risk when price fails at a major level. They also place stop orders nearby. A stop order is not a prediction. It is a safety mechanism. When a large cluster of stops sits below a crowded trade, the market can fall sharply once those stops begin to trigger. Second were the larger funds that manage volatility. Some portfolios target a steady risk level. When volatility rises, they cut exposure. A sudden drop itself increases volatility, which forces another round of selling. This is why a fall can accelerate after it begins. The market starts to behave like a feedback loop. Third were market makers and liquidity providers. And when volatility spikes, they widen spreads to protect themselves. Wider spreads mean the cost of trading rises. Higher costs reduce liquidity. Reduced liquidity makes each market order hit harder. That increases volatility again. The system becomes fragile in minutes. This is one reason silver dropped much more than gold. Silver is more volatile by nature. It is more sensitive to speculative flows. It is also smaller than gold in terms of depth. When large orders hit a thinner market, the price moves faster. Gold is deeper and often held by larger pools of capital that move slower. During stress, gold can still fall, but it often does not fall with the same speed. The technical trigger also explains the emotional pattern that follows. The public sees a sharp drop and calls it panic. Professionals see a rejection at a known level and call it flow. Both groups observe the same chart, but they interpret it differently. The public asks why people lost faith. Professionals ask where the stops were placed. This is why the event was predictable in structure, even if the timing surprised many. A long horizon resistance level is not hidden. It is visible on the map. The map does not guarantee an outcome, but it does warn of higher risk. When price climbs into a multi-decade ceiling after a strong run, the probability of a sharp pullback rises because positioning becomes crowded and protection orders cluster. For business owners and entrepreneurs, the lesson is not to become a chart expert. The lesson is to respect known stress zones. In any market, there are levels where leverage tends to build, where confidence peaks, and where forced behavior can appear. Those levels become risk events, even if the underlying fundamentals look strong. Closes with a practical conclusion. The technical rejection explains why the first wave of selling began and why it hit silver harder. But the technical story is only half of the full explanation. The second half is mechanical, and it is often more powerful than headlines. In part 3, the analysis will explain the margin mechanism that can force selling even from people who still believe the long-term story is bullish. explains the second trigger, the one that turns a sharp decline into a waterfall. This trigger is mechanical. It does not require fear, bad news, or a change in fundamentals. It only requires leverage and a rule change. In the precious metals futures market, most of the visible price is discovered through contracts, not through physical bars moving from hand to hand. Futures allow traders to control large exposure with a relatively small amount of cash. This is called leverage. Leverage can amplify gains, but it also amplifies fragility. When conditions tighten, leverage forces behavior. A futures contract is a promise to buy or sell a fixed quantity of metal at a future date. The key detail is that traders do not pay for the full value of that contract up front. Instead, they post a fraction of the value as collateral. That collateral is called margin. Margin is not a fee. It is a performance bond. It exists to reduce the risk that a trader cannot meet obligations if the market moves against them. Exchanges set the margin rules, and those rules can change quickly when volatility rises. This is where the trap appears. If the exchange raises margin requirements, every trader holding a leveraged position must immediately post more cash or reduce the position. The trader's opinion does not matter. A trader can be confident, rational, and correct about the long-term direction. If the trader does not have the cash, the position must be cut. The market does not wait for conviction to play out. It demands liquidity on schedule. In the episode under review, margin requirements for silver futures were reportedly raised sharply. The exact percentage is less important than the effect. The cost to carry the same exposure increased overnight. Traders who were already operating near their limits had only two options: add cash quickly or sell contracts quickly. Most cannot add cash quickly. That is the point. Leverage works because people deploy it to maximize exposure with limited capital. When the rules change, the limited capital becomes the constraint, so the forced selling begins. It often begins with smaller leverage traders, then spreads to larger funds that run strict risk frameworks. When prices start dropping, losses accumulate, and margin calls intensify. A margin call is a demand for more collateral, triggered by the loss on the position. If the trader cannot meet it, the broker or clearing firm closes the position. This closure is not a choice. It is liquidation. Liquidation is the engine of fast crashes. Once liquidations begin, price drops can accelerate through several channels at the same time. Stops are triggered. Volatility rises. Liquidity providers widen spreads. Algorithms reduce risk. The market becomes one-sided. This explains why silver fell far more than gold. Silver futures often attract higher leverage and more speculative participation because silver's price moves more. When margin rules tighten, the market that was most leveraged is the one that must sell the fastest. That market becomes the pressure release valve for the entire complex. This is also why the crash can feel disconnected from the real world. Fundamentals can remain bullish, and yet the price can fall hard. In those moments, the price is not the market's best estimate of long-term value. It is the market's response to short-term funding constraints. History reinforces this pattern. When exchanges tighten margin in an overheated market, prices often fall quickly. The goal is stability, but the immediate effect is a wave of forced deleveraging. This mechanism has appeared before in different eras, under different names, with similar results. The important point for decision makers is not to debate whether the rule change was fair. The important point is to understand what it reveals. It reveals that a large portion of the market was not positioned to hold through volatility without external funding. That is a weakness. A market built on leverage can rise quickly, but it is vulnerable to the smallest shifts in the cost of carry. When the cost of carry rises, the market must shrink to fit the available capital. This is the connection to the real economy. Business leaders operate under the same principle. When credit tightens, companies reduce exposure. They cut inventory, delay projects, and protect cash. Markets do the same. They reduce risk. They sell what they can sell, not what they want to sell. Also introduces a second indicator that professionals watch closely during these events: the relationship between paper price and physical availability. During a paper-driven liquidation, the paper price can fall faster than physical pricing adjusts. Dealers may not reduce prices at the same speed because physical supply is not instantly expanding. In some cases, physical premiums rise when the paper price drops because buyers rush in to capture what they perceive as a discount. When that happens, it indicates that the paper market is clearing leverage, while the physical market is reflecting scarcity and demand. That divergence matters, because it suggests the crash may be more about positioning than about demand destruction. Ends with a hard conclusion. The technical trigger explains where the market hit the ceiling. The mechanical trigger explains why the fall was so fast and so uneven. Together, they form a single message. In a leveraged system, the rules of collateral can overpower the story of fundamentals in the short term. We'll translate this into a decision framework. It will present two scenarios, outline the indicators that separate them, and show how serious operators protect themselves when markets are moving faster than narratives. turns analysis into a decision framework. The drop was violent, but a single event does not define the regime. The central question for serious operators is whether this was a reset inside a broader uptrend or the first stage of a deeper unwind. The answer will not come from headlines. It will come from indicators that reveal whether the market is clearing leverage or losing real demand. The first scenario is a controlled reset. In this scenario, the market experienced a fast deleveraging, but the long-term drivers remain intact. Prices stabilize, volatility cools, and the market begins building a base for the next move. This is not a cheerful story. It is still painful, but it is orderly. The second scenario is a deeper unwind. In this scenario, the drop is the start of a larger repricing. Leverage does not clear cleanly. Risk appetite fades across markets. Liquidity continues to retreat. What looked like a correction becomes a trend change, at least for a meaningful period. To separate these scenarios, decision makers need a scoreboard. The first indicator is the behavior around a key psychological price level. Silver tends to anchor around round numbers because they function as mental checkpoints and as levels where orders cluster. If silver can hold above a major level on a weekly closing basis and stop producing rapid lower lows, that supports the reset scenario. If it repeatedly fails, breaks down, and cannot reclaim the level, that supports the unwind scenario. The second indicator is volatility itself. In a reset, volatility spikes and then fades as the market clears forced selling. In a deeper unwind, volatility remains elevated and becomes a permanent tax on capital. High sustained volatility forces systematic funds to reduce exposure for longer, which keeps pressure on price. The third indicator is physical premiums. This matters because it tests whether demand and supply conditions remain tight. If physical premiums hold steady or rise while paper prices drop, it suggests that buyers still want the metal and that supply is not meeting demand easily. And that supports the reset scenario. If premiums collapse quickly, it suggests demand is weakening or supply is easing. That supports the unwind scenario. The fourth indicator is exchange inventory behavior, especially the portion that is readily deliverable. Paper markets can trade enormous volume without moving metal. But inventory trends show whether metal is flowing into storage or being withdrawn. If readily deliverable inventory continues to drain or remains tight, it supports the thesis that fundamental pressure is still present. If inventory rises meaningfully, it may indicate that supply constraints are easing or that demand is weakening. The fifth indicator is policy or rule action from key institutions. The episode involved margin dynamics. If additional margin increases occur, forced deleveraging can repeat even if fundamentals remain strong. That would increase the probability of continued downside volatility. If margin rules stabilize and liquidity conditions improve, the probability of a base forming improves. The sixth indicator is the spread between regions and pricing venues. In metals, regional premiums can reveal where the strongest demand is located. A persistent premium in one region compared to another can indicate physical tightness and a pull on supply. A narrowing premium can signal that stress is easing. These are not perfect signals, but they matter because they relate to the real flow of metal rather than to paper positioning. With these indicators in mind, the strategic lesson becomes clearer. This event is a reminder that markets can punish the wrong structure even when the long-term thesis is still valid. The wrong structure is excess leverage, weak liquidity planning, and an entry strategy that assumes markets move smoothly. For entrepreneurs and business leaders, the same principle applies. A company can be strategically correct and still fail if it cannot survive a liquidity shock. In markets, a position can be directionally correct and still fail if it is forced to liquidate at the wrong time. A disciplined operator focuses on what can be controlled. Position sizing matters. Overexposure turns volatility into existential risk. Liquidity buffers matter. When margins rise or volatility spikes, access to cash determines who survives. Entry discipline matters. Scaling into a position reduces the risk of buying too early in a correction. Exit rules matter. A plan should be defined before stress arrives. This is also where the public debate about manipulation becomes less useful. There may be actors with incentives. There may be timing that looks suspicious. But decision makers cannot build strategy on unprovable motives. They can build strategy on observable mechanics, leverage, margins, liquidity, and flows. With the practical meaning of the episode, the drop revealed how quickly a crowded trade can unwind when it meets a long horizon technical ceiling and a higher cost of carry. It also revealed that the market's short-term behavior can diverge from its long-term fundamentals. That divergence is not comforting, but it is useful. It tells serious participants where the weak hands were and where the forced selling pressure originated. The story is not whether silver fell in 90 minutes. The story is what the fall exposed. A system where rule changes can trigger cascades, where liquidity can vanish, and where the cost of leverage can rise without warning. For anyone building a business or managing capital, that is not entertainment. It is a strategic warning.